Hey everyone, it's Mark. I'm here to help you put more money in your pocket through credit cards and smart financial habits. If that sounds good to you, then do me a quick favor and click on the like and subscribe button down below. Also, if you'd like to learn how to start your own online business to increase your income and have me guide you through the process, be sure to check out the link in the description below. Now today we're going to talk about a question that so many people ask all the time, and it's a very good question too. When should I get a new credit card, or how often should I apply for a new credit card? Now, that answer can get very complex, especially because it can often vary by issuer. Chase has their own rules, Citibank has their rules, Bank of America has their rules, and on the list goes. But for the purpose of this video, we're going to keep things very simple and come up with a general rule that will help guide you now and going forward. So that way, when you go out to apply for your first credit card, or your second, or your third, or that one was metal, by the way. There we go. Third, or fourth, or fifth credit cards, or beyond, then you know exactly how to time your applications to both maximize your score, maximize your rewards, and decrease the chances of you destroying your score from opening up way too many cards. Now, for those of you out there who don't want to wait 7 to 10 minutes to figure out when you should apply for new credit cards, I'll give you an answer right up front. In your first year of building credit, I recommend you get 1 or 2 credit cards and build that score for the entire first year. Those should ideally be secured credit cards. Then after your first year, go ahead and apply for 1 card every 3 months on average. And there you have it. But for those of you who would like to learn why that is, or how I came up with this 1 card every 3 months starting in year 2, or why you should get 1 or 2 cards, specifically secured cards, in year 1, I'll now go into an explanation to help you understand these concepts. Now, before we dive into this too deep, I know there's going to be a Graham Stephan moment out there where you're going to have a black and white part of the video and tons of haters down there in the comments saying, but Mark, I got 3 cards in 1 month, so your rule of 1 card every 3 months is total BS. In fact, next month, I'm going to get 50 cards in 1 month, so shove it. And to all that I say, good for you. But I'm not going to be covering all these small outlier scenarios, the fringe cases, and all that. I'm coming up with a general rule that will apply to most people most of the time to help them along their credit journey. So for that reason, we've got a disclaimer to make. For this video, we are speaking in general, so you can increase your chances of approval without destroying your credit score. Therefore, this is not a hard rule. You can get 2 cards from different banks in the same month. You can get 2 cards in the same month from the same bank. You might even be able to get 3 cards in the same month. But here's the thing, early on in your journey, the more new cards you get in a short period of time, that will drive down your score temporarily, but that will make it harder to get more cards in that short term or even in the midterm, because your credit report is so filled with inquiries and new accounts being opened. So again, to maximize your chance of approval and minimize your chance of really tanking your score in the short term, here's what we're going to do. We'll start by understanding a few simple concepts here. The most important factors determining your odds of approval are your credit score, the individual credit factors that help make up your score, and your income. So let me explain why these 3 main factors are so important, and then we'll move from that into understanding how often you should apply for new cards. First of all, your credit score is the numerical expression representing your level of creditworthiness. And the typical range used by the majority of scoring models is 300 to 850. The higher the number, the better your score. So the advice here is very simple. You want to get your score as high as possible. Next up, we have the credit factors. Payment history, making up 35% of your score. Utilization ratio, making up 30% of your score. The length of credit history, which is 15%. The mix of account at 10%, and new accounts also at 10%. In short, here's what you want to focus on here. When you get your bill, make sure that you pay on time and in full each month before the due date on your statement. That will build positive payment history. Second, don't max out your credit cards and do your best to avoid using a huge chunk of your available credit. The lower you can keep your balances, the better your score will be. The sweet spot is anywhere from 10 to 30% of your available credit on an individual card and across all of your cards. Then make sure you keep your early card or cards open long term, especially if they have no annual fee. The longer your credit history, showing that positive payment history and other factors, the better. That's your length of credit history or your average age of accounts. It can also be somewhat beneficial to have a mix of different accounts, meaning a few different credit cards and or a student loan and or an auto loan and or a mortgage. The list goes on. Basically, banks and financial institutions like to see you being responsible with a variety of different financial products. All that said, it only accounts for 10% of your score, and you can do very, very well with even 1 or 2 credit cards, so don't go overboard here. And then lastly, you don't want to open up too many new accounts in too short of a period of time, because the more you open up those new accounts, you'll have new inquiries, and you'll also drive down your length of credit history, because that's an average. You take all the ages of all your cards added together, divide it by how many cards you have to get your average age. And of course, if you open up a whole bunch of new accounts, they're very young, and that will drive down that age and therefore hurt your score. So you want to keep your new accounts in check by not having too many of them. Lastly is your income, and it's pretty simple to understand. The higher the income, the higher the credit line in general, and the lower the income, the lower the credit line in general. The reason why banks care about income in addition to your credit score and your credit factors is simply because that's how they are able to understand their risk allocation. They don't want to extend a huge line of credit to somebody with a small income because on paper at least, their chances of paying off a large balance in case they got into financial hardship is very low. And then the bank would be on the line to pay a balance if that person defaulted. And then that would come back to hurt the consumer as well because the bank would likely close their account and basically sever the relationship. So if you're able to show an income high enough to cover all of your living expenses and have some left over, the banks will be more likely to extend you more buying power in the form of a higher line of credit. Now let me give you a quick example of the credit factors and how they can actually go into your odds of approval for a new card. Let's say we've got 2 different individuals, both have an equal credit score. You can see there at the top, 685. But the guy on the left, the one with the blue tie, is using $3,000 of his $4,000 limit. Therefore, his utilization is 75%. He goes to apply for a credit card and he gets denied. But the guy in the blue shirt on the other side is only using $400 of his $1,500 limit. Therefore, his utilization is much lower in that sweet spot of 10 to 30%. Again, not a hard rule, but a general recommendation, which is a much lower utilization, and therefore he got approved for a card. So even though they had identical credit scores, the underlying factors were very different. And yes, banks look beyond this score into the factors and some more details on your credit report to determine your level of credit worthiness. Now that example was for illustrative purposes only, but it just gives you an idea of what banks might look for. So if you want to increase your chances of approval without tanking your score from too many inquiries, too many new accounts, insufficient length of credit history, also called average age of accounts, then what should you do? Well, in year 1, I recommend getting 1 or 2 credit cards a few months apart from each other. Likely secured credit cards because those will be much easier to get approved for, especially if you have no credit history built up already. The same holds true if you have bad credit and you want to rebuild. Secured credit cards are a great tool for both of those scenarios. Your focus in this first year stage of credit building is just that. You want to build credit. Use your first cards responsively, build the relationships, show that positive payment history, get those 5 factors looking very good, and get your score as high as possible, ideally into the high 600s or even into the 700s would be best. Then in year 2 and beyond, I suggest getting 1 card every 3 months on average. The focus here can be more on rewards, the cashback, the travel rewards points, the sign-up bonuses, etc. And of course, you want to be mindful of the rules by individual banks as well. Because yes, banks don't love it when people get a card for a huge bonus and then never use their card again. Now in the coming months, I do plan to do some videos on credit card application rules on specific banks, so that way you know what they look for and what would turn them off. And I'm not going to put all those rules in this video because that would make this video probably 45 minutes long. Sticking to 1 card every 3 months is a great rate at which to apply for new cards to get you some new products in your wallet, a bunch of new sign-up bonuses every single year, and avoid having a bunch of new inquiries and newly opened accounts that will make your score suffer in the short term. Plus, a lot of the sign-up bonuses that most banks issue have a spend requirement that lasts for about 3 months. For example, spend $3,000 in the first 3 months of card card membership. So that 1 card every 3 month rule also helps respect your ability to spend and get that bonus without having to rush anything or even entertain the idea of spending more money than you normally spend anyway. That's not a good idea. Now, with all that said, if you enjoyed this video and believe it could benefit others, then please help me get it in front of more people by liking this video, subscribing to the channel, and turning on notifications. Also, be sure to check out the links in the description below in case you'd like to apply for a new credit card while supporting this channel. They are my referral links. And I have another link down there as well for those of you who are interested in starting your own online business to increase your income, which can also help you get approved for more credit cards. So if either of those interest you, check out those links down below. Thank you all so much for watching today's video. I will see you again in future videos, and until then, remember, you are great.